There are many reasons to be optimistic. The momentum is positive, Bitcoin is close to the all-time high, we see continued purchases through the Bitcoin treasury companies, we also see more and more purchases through the Bitcoin ETFs. So what can really go wrong here? In this video, I want to paint a more objective picture. We do look at the positive side of the story, but there's also potential risks in the market that continue to accumulate that most people don't look at. Now here's why everybody is so excited. This is the amount of Bitcoin that's purchased through the treasury companies. And it's not just Michael Saylor's MicroStrategy that's buying, it's all kind of other companies as well that just continue to accumulate. Now the reason why this is so positive is because in sum, those entities tend to just buy. This is pretty much monotonically increasing, and that reduces Bitcoin's liquid supply over time, and that should in turn increase the price. We don't just have the treasury companies, we've also got the Bitcoin ETFs, so that's now the line in purple. It also tends to just monotonically increase, again, reducing the liquid supply, thus pushing up the price long term. The rate of acquisition through the treasury companies recently tends to be higher than the rate of acquisition through the ETFs. And the ETFs alone, if we annualize that acquisition, we get 3.4% of the entire Bitcoin supply getting scooped up by Wall Street. So both of those entities together is probably above 7% per annum. And this is so positive because the inflation rate of Bitcoin, so the new issued Bitcoin every year through the Bitcoin mining, is much less than that. It's roughly 1/10. It's only 0.85% per annum. So Wall Street is buying at a rate of 10x the supply expansion. And in a bit over a year, that supply expansion will drop even further, right? This is the Bitcoin halving. We'll see only 0.41% of new Bitcoin hitting the market every year. On top of all of that, we've got Bitcoin that gets lost over time. So not all Bitcoin gets purchased through the ETFs. Some Bitcoin is held in self-custody, and sometimes the hardware wallets break, the recovery phrases get forgotten, and so the Bitcoin is lost forever. Here's the Bitcoin that has not moved for the last 7 years. It's now at 25% of the entire supply. 5 years ago, we were only at 15% of the supply. So roughly 2% of Bitcoin supply gets lost every single year. Again, showing how the asset becomes more and more rare over time. And so that's the positive side of the story, right? Bitcoin gets acquired by people that tend to just set and forget. They just allocate within a portfolio. They tend to not take profit at any price. And at the same time, the amount of US dollars that circulate continues to grow, right? Over the very long term, the US monetary base grows by roughly 6.8% per annum. So long term, this seems to be just one direction, Bitcoin going up. But here are the things that people ignore. This is the number of Bitcoin that's held by centralized exchanges. And there are some people that see this as a positive sign. I see this rather as a potential systemic risk. So there's less and less Bitcoin. This chart starts just 2 years ago, and the balance went from 2.8 million to 2.2 million. So roughly 300,000 Bitcoin that leaves the centralized exchanges every year. There's maybe 7 more years left until this hits 0 at the current rate. Some people say this is good because as this declines, the centralized exchanges have to buy back the Bitcoin, potentially from people that have it in self-custody. But really, I've got the impression that this could destabilize the system because the centralized exchanges won't start delisting Bitcoin. They might just offer artificial paper Bitcoin that aren't really properly backed. FTX, for example, never held a single Bitcoin. And so it seems like the centralized exchanges are getting into a weaker and weaker financial position. Here's another way to look at this. Here is the number of Tether that's held by the centralized exchanges. This continues to go up. And so really, do we want to have the most important, the largest players in the entire ecosystem holding more and more of a weak asset that might not even be fully backed and less of a strong asset? I'm not so sure. If a centralized exchange goes belly up, if something like FTX implodes, this does have a bad impact on all crypto prices. Another implosion of a large centralized player, maybe if suddenly Binance goes bankrupt, that would shake the confidence in the entire space. And again, the balance sheet of the centralized exchanges is getting worse over the years. Here's another development that's rather questionable. There are less and less transactions happening on the spot market and more transactions happening on the perpetual futures market. So people are really just betting on the direction of prices. People aren't buying and selling the underlying asset that much anymore. Have a look at the Bitcoin long-term price, so that's in yellow, and compare this with the open interest on CME. So that's perpetual futures on Wall Street. It tends to grow much faster than the price, so more and more bets are made on the price, which then through arbitrage bots, in case of forced liquidations, can roll over to the spot price as well. So there's more and more inherent risk in the market. Now this is Bitcoin. Here we've got the same, even in an amplified form for Ethereum. Ethereum is close to the all-time high, but the amount of open interest that went from 12 billion all the way to 60 billion. That 6x'd during the last 4 years. And so this green line is an expression of leverage in the market, right? Why do people use perpetual futures? They use them in order to bet on the price short term with leverage. If then the position goes against the bets, if suddenly, say, Bitcoin crashes by 10%, we see forced liquidations on the perpetual futures, which will then push the spot price even further down. So more and more open interest means more and more risk. A very similar development to what we already see with the financial health of the centralized exchanges. It seems like a never-ending story. When we recover from a bear market, when we enter a bull run, people are getting more and more risk on. Just the vehicle that they're used to getting more risk on changes over time. In 2018, it tended to be the small altcoins. It tended to be the ICOs that made the rally. In 2020 and 2021, it tended to be decentralized finance and a lot of inherent leverage via artificially created stablecoins, right? The UST stablecoin, the Anchor protocol, went belly up. And that's what created the deleveraging. This time, we see again the market recovering, but it's not necessarily just because so many new investors enter the space. It's at least partially also because of more and more leverage entering through the perpetual futures, through the bets on various crypto assets. There are potential red flags. Ethereum has turned around at around $4,400 several times. We do have our resistance here. We see less trading volume on the spot market for Bitcoin in the last 24 hours, 15 billion here, compared to the perpetual futures market, 47 billion here. The same is true for Ethereum, 6.6 billion on spot versus 27 billion on the perps. And so really the price discovery now does not happen anymore by people buying and selling the asset. It really happens just through the bets on the price. People are levering up their positions more and more. Now don't get me wrong, I don't think that this momentum will suddenly turn around. I do think that the market is still expanding, but at the same time I also think that risk is increasing over time. I don't think that the concept of bear markets is a thing of the past. I do think, especially with all of this additional leverage that's entering, that we still will see quite a bit of volatility in the future, and that drops of 30, 40, 50% in the Bitcoin price can still happen. Just have a look at the trading volume on the perpetual futures over time and compare this with the trading volume of the spot market over time. On the perps, we already see more trading volume than on the spot market. 3 years ago, we had roughly 6 or 7 billion worth of trading volume per day on the spot market. Today it's around 20 billion, so this has tripled. The perpetual futures market was at around 2 to 3 billion, and that's now at 30, so more than a 10x in terms of trading volume. The situation has progressed already that far that the market cap of the largest decentralized exchange is not anymore Uniswap, so the spot trading platform. It is Hyperliquid, the leading perpetual futures exchange. And the difference is significant. Uniswap, which is on many blockchains has a market cap of only 4.7 billion. Hyperliquid, which has some token inflation ahead as well, has a market cap of 12.5 billion. So the tokenomics of Hyperliquid are worse. The market cap is much, much larger. And that's all due to this shift happening in the market. People getting more and more excited about adding more and more leverage to their positions. At the face of it, it looks like this time is different. The entities that are buying Bitcoin, they tend to not sell during a bear market. And that should long-term push up the price. And yes, very long-term, I agree. Bitcoin is getting lost, Bitcoin is getting acquired, and Bitcoin isn't expanding in supply. And that will push up US dollar valuations of various cryptocurrencies long-term. But that does not mean that we can't see a bear market anymore. This year was still a drop of 70%. And seeing a 60% drop here, maybe not today, maybe not even in the next year, but at some point, another 60% correction is very much on the cards, given all of this leverage that we now see building up. And so all I'm saying is don't put 100% of your net worth in crypto, right? Be somewhat diversified, maybe own some gold, maybe own some stocks, maybe own some cash, whatever it is, own something that is not correlated with crypto so that then in case we do see the correction that the bottom can be properly bought. Because that's normally the problem. Once we are in a bear market, people have lost their capital, they don't have anything anymore that they can allocate towards the dip. The dip keeps dipping, but people run out of cash. That's not the position you want to be in. Hyperliquid is outperforming Uniswap quite consistently, again, because the market is looking for more and more risk. It's not the altcoins that get all the excitement, it's the perpetual futures instead. And Aster very likely will long-term outperform PancakeSwap as well. It did upon launch, now we've got a retracement, but long-term, again, as long as the market expands and people are getting more risk on, the perpetual futures will do better than the spot markets. Now, isn't this a fascinating effect within crypto? It seems like it doesn't matter what altcoin we pick. They either all go down or they all go up at the same time. If people are bullish, most things appreciate. If people are bearish, most things go down. We can read through the documentation of countless of crypto projects and it seems to not really matter. Instead, what really seems to make the difference is timing the macro environment. When Bitcoin is going down, we should be rather outside of the market. When Bitcoin is going up, we should rather be invested. The trick is to find out ways to at least partially get spared from those more than 70% drops. This is when Bitcoin moved from 69K all the way to 15K. Now I've done a few calculations on crypto. I tried to figure out what's the best moving average for Bitcoin. Should we go long over here? Should we go short over here? What duration as a moving average for trend following is the best? When we run the numbers, we find the 125-day simple moving average works pretty well if no leverage is used. The best leverage, by the way, is 2.25x. So that's when we go long and short with the same leverage. If we only go long, we never bet on falling prices of Bitcoin. We can even lever this up slightly more, 2.75x. If we only short, we should do this with less leverage, only 1x. That's the best. Again, when we use the 125-day simple moving average, the line we see here in turquoise, we bet on rising prices over here and we bet on falling prices during times like this. But falling prices is just 1x, rising prices is 2.75x. Here's the summary in numbers, so the expected annualized return. And here is how that looks like on a chart. So without leverage, the 125-day simple moving average is the best. With leverage, it's actually the 44-day simple moving average that works the best. If you bought and held Bitcoin since 2015, you would have gotten the return marked here in white. If you used the 44-day simple moving average using the optimal leverage, you would have gotten this performance here in turquoise. I'm running all of those numbers because I want to get away from just the gut feel. I don't just want to trade based on news, I want to trade based on a fixed rule set. Because it's very hard to say how well is trading according to the news going to work. But when we've got a fixed rule set, at least you've got something that used to work in the past. That probably has a higher likelihood of continuing to work in the future. The market psychology doesn't fundamentally shift that much over the years. At least that's the thesis. I made several videos that dive into more detail in the premium membership. For example, this one over here or this one over here. And premium members also get access to this here. This is a copy trading capital pool. So instead of having to trade yourself according to the 44-day simple moving average and setting up the right leverage and doing all of those optimizations, you can simply just put your money into this capital pool and I will execute everything for you. I'm also sharing all of my positions outside of the crypto market. For example, here on the 4th of October of 2024, I bought quite a bit of gold. Since then, gold went up by 54%. By the way, I've recently sold half of my gold position. So this is the little freebie here on the YouTube channel. But fundamentally, the idea is that I share my insights and my own trades regularly in premium in various videos. And you're more than welcome to try it out to learn more about those backtest trading simulations, to potentially deploy some capital into that strategy as well. And there is also a money back guarantee. So in case you don't like premium, just message me within the first week and I'll refund you 100%. But of course, the idea is that long-term premium pays for itself, that the capital pool makes enough money that the expenses won't really matter. I think it's a mistake trying to find the perfect altcoin, reading through all the documentation, trying to find the next 10 or 100x, when instead we should actually time the macro environment. Instead, we should take advantage of the market structure. Data is superior to gut feel. Data gives us long-term risk-adjusted outperformance. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. Again, if you don't like it, just message me. I'll refund you 100% within the first week. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.